Hey everyone, welcome back to Corporate Decoder. Today, Cellyan Biotechnology Co. Ltd filed its annual report on Form 20F, and there is one glaring number that really caught my eye. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's revenue dropped significantly last year, and they're facing a serious risk of being delisted from Nasdaq, which could be a major blow. Let's dive into the core of this filing, which is Cellyan Biotechnology's annual report for the fiscal year ending the 31st of March 2026. As an emerging growth company, they are taking advantage of certain reporting exemptions, which means we might get less detailed information than from more established companies. This itself can be a risk, as it makes it harder to fully assess their financial health. Now, let's talk about the risks, and Cellyan has quite a few. They operate in a highly competitive supply chain services industry, especially for OTCC pharmaceuticals. If larger logistics players decide to bring these services in-house, it could seriously hurt Cellyan's market share and profits. Plus, a significant chunk of their revenue comes from just a few big customers, so losing even one of them could be devastating. This kind of customer concentration is always a major red flag for me. A big part of Cellyan's story is its operations in Hong Kong. While Hong Kong has traditionally offered a stable business environment, recent geopolitical developments and new national security laws could create significant operational and legal risks. There is also the ongoing scrutiny from US regulators on Chinese and Hong Kong-based companies listed in the US, which adds a layer of uncertainty to their business operations, share price, and overall reputation. It is a complex situation where political and economic factors can quickly impact business. This next point is crucial. Cellyan Biotechnology received a notification from Nasdaq on the 12th of January 2026, stating that their stock price had been below $1 for 30 consecutive business days. This puts them in danger of being delisted from the Nasdaq capital market. They were granted extensions, with a final deadline to regain compliance by January 2027. This is a critical situation. Historically, when companies face delisting warnings like this, especially micro-cap companies, about half of them eventually get delisted. For example, when Kodak faced similar issues around 2021 with a reverse split, its shareholders saw an additional 40% drawdown in value over the next 90 days, turning a $1,000 investment into about $600. This risk of delisting can severely impact liquidity and make it harder to raise future capital. Let's look at the numbers in the year ending the 31st of March 2026. Cellyan Biotechnology saw a significant drop in revenue, down 34% to about $13.4 million from $20.3 million in the previous year. This decline was primarily driven by a 39% decrease in their supply chain services revenue, which is concerning, and a 22% drop in procurement and distribution revenue. This revenue drop directly impacted their bottom line. They reported a net loss of over $1.1 million for the year ending the 31st of March 2026, a stark contrast to a small loss of just $27,000 in the prior year. This significant increase in net loss, a jump of over 4,000%, is clearly a major concern. Looking at their balance sheet as of the 31st of March 2026, their total assets were about $12.8 million, with current assets making up a large portion. However, their current liabilities are also substantial. They have over $3.2 million in total liabilities compared to about $9.6 million in total shareholders' equity, which is a bit concerning. Their cash flow situation also paints a concerning picture. For the year ending the 31st of March 2026, they used over $750,000 in operating activities, a significant shift from the positive cash flow of over $560,000 in the previous year. This outflow suggests that their core business operations are currently burning through cash. Digging into their equity, we see a large increase in additional paid-in capital. This is largely due to their initial public offering and a private placement. In March 2026 alone, they raised about $6.5 million through a private placement of shares and warrants. While this injected much needed cash, it also means more dilution for existing shareholders. Now, let's talk about the going concern issue. The auditors themselves pointed out in their report that the company suffered a significant net loss and net cash outflows from operating activities in the last year. Coupled with the Nasdaq minimum bid price deficiency, this raises substantial doubts about the company's ability to continue operating. While management has outlined plans, including proceeds from asset disposals and support from controlling shareholders, the auditors still noted this as a material uncertainty. This is a serious warning sign, similar to what we've seen with companies like Bed Bath & Beyond or Rite Aid, which ultimately faced bankruptcy. And speaking of risks, their largest shareholder, Miss Lang Wang, holds a majority of the voting power. This means she can control all shareholder matters, which could limit your ability to influence corporate decisions and may not always align with the interests of other shareholders. This concentration of power is something investors should always be aware of. The price of Cellyan's Class A ordinary shares has been very volatile, and the report states this could continue regardless of their operating performance. They've experienced significant price swings, and with a relatively small public float, even small actions by a few shareholders can amplify price movements. This volatility makes it tough for investors to get a clear picture of the company's true value. So, what is the takeaway here for Cellyan Biotechnology? On one hand, they've managed to raise significant capital through recent offerings which has bolstered their cash position. They also operate in a growing market for cross-border OTC pharmaceuticals. However, the sharp decline in revenue, the substantial net loss, the critical Nasdaq delisting risk, and the going concern warning from auditors are all major red flags. The fact that their stock price has dipped below $1, a classic precursor to delisting, is particularly worrying. The company's future hinges on their ability to reverse this revenue trend, regain Nasdaq compliance, and prove they can operate as a going concern, all while navigating significant market and regulatory risks. The risk I am watching closest is whether they can maintain their Nasdaq listing, as a delisting would severely impact their access to capital markets and investor confidence. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Love this breakdown. Subscribe and hit the bell. Join our Discord for more.